Cathie Wood, CEO and CIO of ARK Invest, said she wouldn't be shocked to see a big Fed shift in the coming months after Federal Reserve Chair Jerome Powell appeared to maintain expectations of a third consecutive rate hike of 75 basis points. In today's video, we'll talk about Cathie Wood's prediction on inflation. So stay until the end of the video to learn it all. Cathie Wood, CEO and CIO of ARK Invest, thinks the Fed may reduce inflation to 3% in the near term if commodity prices decline and the United States experiences an inventory recession. In September, Wood told Fox Business's Maria Bartiromo, "You've got Europe in recession, China in recession, very much, and here in the United States. Stores are bursting with stocks that will have to be cleared with discounts. Therefore, we predict that over the next 3 to 6 months, inflation will see some significant adverse surprises." Wood discussed how the macroeconomic environment and the Fed's next rate decision are affected by declining commodity prices and an ongoing inventory slump on Mornings with Maria. When it comes to commodities prices, Wood said gold really peaked in August of 2020 and is now at the lower end of a 2-year range. While copper has broken down, oil is breaking down, lumber has crashed, and iron ore as well. Freight rates indicate that supply chains are becoming substantially more flexible. Rates are decreasing. Deflation has occurred in the system. Wood contended that Powell made a mistake by employing the same gold exchange standard sledgehammer to combat inflation as former Chair Paul Volcker used in the 1980s. "That is what I think Chairman Powell needs, in my opinion. And given how much deflation there is, we simply do not believe that to be the case," said Wood. Wood predicted that PCE will continue to show negative numbers for the rest of the year, noting that the Fed's preferred inflation index peaked in February at 5.3%. In the upcoming 3 to 6 months, I wouldn't be surprised to see it far down into the 3s, if not into the 2% handle, Wood added. "And I think the Fed will change its tune fairly drastically if we get enough sequential declines," said the author. "I'd predict they'll change their mind, raising interest rates perhaps by 75 basis points this time, but perhaps by 25 to 50 basis points the following time. After that, we'll have to wait and see." Wood also noted that unless costs fall and stockpiles are sold off, GDP profits could be under tremendous pressure, given the energy crisis in Europe and China's transition to shared prosperity. "We don't anticipate this to resemble 2008 or 2009, as many people fear," the CEO remarked. "We believe it to be more of an inventory recession and an external drag." Wood concurred that there has been some labor hoarding in the market, and that an inventory crisis creates a sharp spike in unemployment in response to former Treasury Secretary Larry Summers' worries that U.S. unemployment could jump to 6% this year. The employment numbers have appeared solid, but if you peel back the onion a little, the underbelly of employment is not strong, with household employment practically flat over the last 4 to 5 months, which includes a lot of small enterprises. The star stock picker also reacted to the firm's most recent market shock after creating the ARK Innovation ETF in 2014 and watched its value plunge by over 60% this year alone. "We're still in the very early stages, so we urge our investors to embrace change as well," according to Wood. "We're absolutely committed, and trust me when I say that it has been excruciatingly hard. In the midst of all of this, we increased our personal ownership in our company. That is how strongly we believe it, and practically every employee took part in it." Cathie Wood of ARK Investment Management wrote an open letter to the Federal Reserve stating that the institution's strict stance against inflation is probably a mistake. Wood argued that the Fed should learn from commodity prices, which show that deflation, not inflation, is the main economic risk moving forward, rather than from employment and price indices from prior months. Wood wrote in the letter, which was posted on the company's website, "The Fed seems focused on 2 variables that, in our view, are lagging indicators: downstream inflation and employment, both of which have been sending conflicting signals, and should be calling into question the Fed's unanimous call for higher interest rates. In particular, both the consumer price and personal consumption expenditures price indices revealed substantial levels of inflation. In August, Headline CPI increased by 0.1% and was up 8.3% annually, while headline PCE increased by 0.3% and 6.2%. Excluding food and energy, which saw significant price decreases over the summer, both values were even higher. In terms of employment, payroll growth has slowed down, but is still solid, adding 263,000 jobs in September, while the unemployment rate dropped to 3.5%. But according to Wood, whose company oversees $14.4 billion in client assets spread across a family of active ETFs, dropping prices for goods like copper, housing, and lumber are conveying a different narrative. The Fed has unanimously authorized 3 consecutive 0.75 percentage point interest rate rises, and it is anticipated that it will approve a fourth when it meets again on November 1 to 2. Unanimous? Really? Wood wrote. Could it be that the globe has been jolted by the historic 13-fold rise in interest rates over the past 6 months? Yes, the Fed is not the only institution hiking interest rates. In September, about 40 central banks across the world approved increases, and the markets largely anticipated all of the Fed's actions. Recently, though, there has been criticism that the Fed might be going too far and running the risk of pushing the economy into an unneeded recession. Food and energy prices are crucial, without a doubt, but the Fed shouldn't, in Wood's words, be fighting and exacerbating the global misery associated with a supply shock to agriculture and energy commodities induced by Russia's invasion of Ukraine. Following the increase in November, the Fed is anticipated to increase rates by 0.5 percentage points in December before cutting rates by 0.25 percentage points early in 2023. According to Morgan Stanley, the overnight index swaps market is pricing in 2 rate decreases by the end of 2023. Cathie Wood, CEO of ARK Investment Management, stated on Peter McCormack's What Bitcoin Did podcast that she bought $100,000 worth of Bitcoin BTC while it was selling for about $250, which would suggest sometime in 2015. She claimed not to have sold any of the original investment. Thus, her current return on the $100,000 wager would be about $7.6 million. Wood claimed that while she was able to place her own wager on Bitcoin, she couldn't do the same in the ARK funds since they were and are only permitted to invest in equities. Her company, which Wood co-founded, focuses on innovative and disruptive ventures. ARK was eventually able to gain exposure to Bitcoin through the Grayscale Bitcoin Trust, GBTC. GBTC shares worth approximately $67.4 million are now held by the ARK Next Generation Internet Fund, ARKW. Wood is still positive on Bitcoin and believes that the Grayscale Trust is trading at a fire sale price, considering the possibility that it would eventually be approved to transform into a spot exchange-traded fund. The trust is now trading at around a 35% discount to net asset value, if regulators allow. It's not just ARKK that has been impacted. Recently, short sellers have been paying up to wage against the funds managed by Wood's ARK Investment Management family. The situation for ARKK and other growth stocks and ETFs wasn't always this way. Wood's flagship ETF had gains of 35% in 2020 and nearly 150% last year, making it a favorite among retail investors and other people who shared Wood's belief in innovation. Over those 2 years, the fund received almost $14 billion in new investments. Although its performance has recently led to significant outflows, it is still on track for inflows this year, according to Mohit Bajaj, Director of ETFs at Wallachbeth Capital. Through the most recent session for which data is available, the fund experienced outflows of $244 million for the month of October. With that, we've come to an end. See you next time. Goodbye.